Ladies and gentlemen, welcome back to the channel. We're going to get into everything you need to know for our markets and this upcoming trading week that are going to move things around. It's going to be a volatile week, and I hope you are ready for it. Let's go ahead and just jump straight into it. Hit the like button, subscribe to the channel. Let me know what you guys think about this information down below in the comments section. We have a lot to get into, so we're not going to waste your time with the intro. First things first, on Monday, markets will be reacting to Moody's. They have cut the U.S. outlook to negative, citing deficits and political polarization. Now, there's two things to know. Kind of like a stock, you get a price target, you get a rating. You get a hold, you get a neutral, you get a sell, you get a buy, you get a outperform, underperform, whatever. You get your rating. So Moody's cut the rating on the U.S. economy. They did not cut essentially the price target on the U.S. economy, which in bond term is your rating, like your AAA, your AA, your triple B, right? If you guys have seen The Big Short, you know how these things can, they get dramatically worse as you go down into the A's and then into the B's. Moody's affirms the long-term issuers and senior unsecured ratings of the U.S. at AAA. Now, Fitch back in August downgraded the U.S. from AAA to AA, and S&P downgraded the U.S. from AAA to AA in 2011. And obviously, the U.S. government came out and says, we disagree with Moody's outlook. The U.S. economy is doing fantastic and growth is doing good and we're not heading into recession, blah, 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 right? Doesn't matter. I don't think this is as bad as some of the other downgrades we have seen because the rating actually did not get downgraded. But simply put, this means that you're probably going to have to pay more to borrow capital if you are the U.S. government, which pretty much means treasury yields are probably going to go higher off of this information. Now, I don't know to what extent, what degree. That's obviously to be continued and will be something the markets will be reacting to in this upcoming week. Now, you also have House Republicans have unveiled their plan to avert a government shutdown next week. Now, a government shutdown usually does not cause an event for our markets, but this time around it could because economic data would be delayed. So it would kind of be a blackout. We just wouldn't know where the economy is, and there would be a lot of backdated data we would need to get. Obviously, the longer the shutdown, the worse it would be. It looks like a lot of people are in support of this. Some people are in opposition to this. Roy, the House Speaker from Texas, Roy Chip, says, quote, "It's a 100% clean. And I 100% oppose," Roy tweeted. "My opposition to the clean CR just announced by the Speaker of the House GOP cannot be overstated, funding Pelosi-level spending and policies for 75 days for future promises." So it's undecided, how this is going to go. It seems like there's wide support from this, and it's kind of like a laddering, right? You fund some things, you don't fund other things, and you figure those other things out later. That's kind of in essence what this is. As we get closer to a government shutdown, if that were to actually happen, that could be an event for our markets and something to keep on your radar, although I don't think it's going to be the most important thing to markets because ultimately there will probably be some stopgap measure to kick the can down the road. Now, for this upcoming week, on Monday, you're not going to get much at all. 3-month, 6-month bond auctions, that's basically it. Monday's going to be the day you're reacting to Moody's, a potential government shutdown. Tuesday's the day you're going to be reacting to inflation. Now, core inflation month over month is expected at 0.3%. Last month, you were at 0.3%. Core inflation year over year expected at 4.1%. Last month, you were at 4.1%. Your inflation rate month over month was expected at 0.1%. Last month was at 0.4%. And your inflation rate year over year was expected at 3.3%. Is expected at 3.3%. Last month was at 3.7%. My personal expectation is they're probably spot on with headline inflation. Core's probably going to decline a little bit more than expectations. Core might come in at 0.2%. That would be 2.4% annualized. And your year over year might come in at around 3.9%. People I talk to, the agents that I talk to, I am still technically a licensed real estate agent, but I'm not active in doing that as much anymore. More so just buying rental properties is what I like to do. And what I'm hearing from renters and other, rent managers, right? Property managers is they're really not raising rents to the same degree as they were. If they were raising rents at $50 a month or a year, now they're raising them at $20 or $25 a year for a new lease. So you're still seeing some inflation there, obviously, because of the supply demand dynamics of real estate. The population has doubled since 1960, and we're building less houses today than we were then. And I would imagine the population is even higher than we expect due to all of the immigration. You could be at 380 million people living in the US back in 1960. You were at 165-ish million people living in the country. So big things have changed over the last decades, and well, we're just not building houses the way that we need to. There is a supply-demand shortage, and there will be for a very long time. So I don't think that's necessarily going to stop the Fed from cutting rates, right? If you continue to see a hot core, that should be expected. But I think it's going to come in a little bit lighter. Now, you're going to get a bunch of Fed speakers on Tuesday and on Wednesday as well. But the big data, I think almost as important as CPI is going to be retail sales. You're expecting retail sales a negative 0.1%. Trading Economics is estimating 0%. Last month, you were at 0.7%. So if retail sales were to come in really negative, then you get fears of a recession. And that's what happened back in September, October of 2022. That's why the markets fell. Fears of a recession. Part of it was declining retail sales. Part of it was just other things that were going on at that time, right? The dollar was rocketing higher. Just the economy was at a very precarious moment. All of the surveys you were seeing were saying there was like a 90% chance of going into a recession. Bloomberg at one point put a 100% chance of a 2023 recession. Now, GDP, 70% of US GDP is comprised of personal spending, personal consumption. So if retail sales comes in really bad, let's say it comes in at half of 1% or 1% negative, people are going to start to fear this recession. And that might outweigh a positive CPI report that we get on Tuesday. That's, I think, the biggest cause, potential cause for concern for this week. Now, PPI, I think that's going to be a non-event. You're expecting 0.1%. That would be great. It's really the wholesale side of inflation. Last month was 0.5%, but I think CPI is going to be a lot more important than that on Tuesday. And then throughout the rest of the day on Wednesday, you're going to get a lot of secondary data, let's call it. You're going to get New York Empire State Manufacturing Index. You're going to get Fed Bar, business inventories, lots of oil data that will be coming out. Lots of Japan data as well. Some Russia data in there. The NOPA crush report at 1 p.m. Lots of secondary data that I think can give you small moves, but it's not going to give you the biggest overall move for our markets. Now, if you look at Thursday, that's where you're going to get a lot more of that secondary data. Philly Fed manufacturing, Fed Mester, import prices, initial jobless claims, export prices, Philly Fed business conditions, CapEx index, Philly Fed employment, Philly Fed new orders, Philly Fed prices paid, industrial production month over month, year over year, capacity utilization, manufacturing production year over year, and month over month, Fed Williams, NAHB housing market index, Fed Waller, Fed Bar, Kansas Fed Composite Index, Kansas Fed Manufacturing Index, Fed Mester, foreign bond investment, net long-term TIC flows, lots of secondary data reports on Thursday. And then on Friday, it's just building permits. So we want to see that number come up a lot. That would be good news, although I do not have the highest expectations that will actually happen. The big story of this upcoming week will likely be bond yields and the course of Fed policy. I think CPI, I think all of these things will just have an effect on bond yields and on the course of Fed policy. If bond yields continue to fall the way that they have recently from that high of 5% now down to 4.64%, that's going to be really good for stocks. And I think even in the shorter term, going back to 3.2 or 4.2 or even 4%, an area in which we were in back in the beginning of August, isn't impossible, especially if this data continues to look like the Fed is going to U-turn. Now, current estimates for GDP are sitting from the Atlanta Fed at 2.1%. Your average expectation from economists is about 0.9%. On the low end, they're negative, about 0.2%. On the high end, about 1.7% is the estimate from analysts. So Atlanta Fed GDP is way higher than the average analyst estimate for Q4 GDP. Another big event for this week is going to be earnings. Now, there's a lot of different sectors that will be reporting earnings, but you should really highlight the retailers, right? Home Depot, Tuesday pre-market. Target, Wednesday pre-market. Zim, TJX. And then you're going to have Wednesday after hours. A couple guys, Palo Alto, Cisco. Those are probably the two ones that a lot of people want to pay attention to. Thursday pre-market, Alibaba, Walmart, Macy's. Thursday after hours, Ross and Gap, as well as Dolby and Applied Materials. So a lot of retailers this week. Retailers, their CEOs, what they say on earnings calls will be very important, potentially will move the markets as well. And then for your AI investor sentiment, you have seen a huge flip from 50.3% of investors that were bearish on November 1st to 27.2% of investors that are now bearish for the week ending November 8th. So looking a lot better than we were previously, that is for sure. And if you take a look at this is going to be the percentage of stocks that are above their 50-day moving averages. That sits at 40%, which if we get back to where we were in July, that would put you at, like 75%. And that actually, could reasonably happen in my personal opinion. If you look at the broader markets, if you look at something like the NASDAQ, you're in a cup and handle formation. This has all been confirmed. There's the cup, the handle, and you get the breakout. And look at our markets. I mean, cup, handle, breakout. This could send you to the prior peak or even higher, usually higher than your cup peak. And this particular cup connects the highs from back in 2011, right, for the NASDAQ, and back during July of 2023. So that could send you to new all-time highs for our market, specifically the NASDAQ. This would only be a rise of about 6.5%. Now, I don't necessarily think you get back to all-time highs just with big tech leading. I do think markets will start to look ahead to who's going to benefit from rates coming down. That's going to be something like a Tesla. That's going to be small, mid-cap companies that do have a little bit more debt that might need to refinance. Those are the guys I want to be positioned in right now. Again, I'm tactically bullish from now until maybe the end of the year, the Santa Claus rally. The beginning of 2024, the first 2 quarters of 2024 are a lot harder to interpret. I think it's pretty clear. By the end of 2024, rates are going to be a lot lower. Certain stocks, certain sectors, like I said, interest rate sensitive sectors, probably going to be in a pretty good place. But from now until, from the start of 2024 until the midpoint of 2024, that's hard to tell. From now until the end of the year, it looks pretty dang bullish to me. So that's going to go ahead and do it for this video. We have a lot of AMC specific things to get into in the next video, including some pretty bad news that is coming out over this weekend, in particular for movie theaters. So that's going to do it. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.